Oakmark Funds U.S. CIO Portfolio Manager Bill Nygren with us as we await the Q&A portion of Powell's testimony. Bill, good to see you again. Good morning.
Good morning. Thank you for having me.
Always good to have you. I wonder how you'd characterize right now the environment for value, given some of the swings we've seen at least the last couple of days.
Well, I mean, certainly so far this year, it's not been a good time to be a value investor. The Russell growth has been off to the races again like it was in the prior year, 2023. But what that's created, Carl, is an environment where a lot of the stocks in the S&P 500 trade at more than twice the multiple of the market. Market's about 20 times earnings. And I think there are a quarter of the names in the S&P 500 that trade at more than twice that multiple. At the other end of the distribution, there are a quarter of the names that trade at about half the market multiple. So for a value investor like Oakmark, this is a really exciting time, because we can put together a pretty well-diversified portfolio and pay barely more than 10 times earnings.
We normally zero to the top of your top holdings list, and Alphabet is one name we always come back to, Bill. How interesting is that story getting lately? What do you make of the recent price action?
Yeah, Alphabet is one of the few names of the really large S&P 500 names that we think has become more attractive than it was a year ago. The stock has lagged the other large tech companies. We think that some of the important things to look at are how much search revenue has grown. A year ago, everyone was concerned that when Bing incorporated ChatGPT, it would mean a major market share loss for Google. And market share data that we've seen even so far in 2024 shows that Google has not lost any market share at all. So the stock's selling at below the market PE multiple. If you make adjustments for cash and other bets, we think we're paying something more like 13 times earnings for search. And we think that's an incredibly good opportunity.
Bill, just because they haven't lost market share doesn't mean they're not going to. It's very early days for generative AI, and the reason the stock is trading where it is in part is because people do fear that ultimately their lockhold on search is going to be dislodged. And you clearly just don't agree, and I'm curious as to why. I mean, looking at backward data doesn't necessarily tell you, as we watch these generative AI models increase in scope, size, ubiquity, and usage, that Google doesn't have a lot to worry about, particularly given how slow they seem to be moving to try to combat them.
Well, I think part of how slow they've been at releasing product is just they've got a lot more to lose than the companies that the AI is not supporting a large basic business. Consumers expect Google to deliver accurate results to them. And they just can't risk losing that trust of the consumer by incorporating everything they've done in AI into the search program right now. And certainly you're right, David. It's no guarantee that a backward look guarantees future performance, just like in fund performance. Past performance is no guarantee. But I think it is interesting that the fear level for Google was just as high a year ago, and so far the results don't indicate that AI has been a problem for search.